So welcome to the Client Review Workshop, the webinar version. Hopefully this is a convenient way for you to get a review of your finances. Now, we've been doing the Client Review Workshop for 3 years now, and the reason that we did it originally was that we were finding we always did our review process as a one-to-one conversation with the advisor, and we were trying to cram it into an hour and a half. And what we were finding, there was lots of stuff that we wanted to talk about in terms of how the markets were progressing, how the investment manager was doing, any legislation changes, any planning opportunities. And then, of course, there's all the stuff that's unique to you. And we were finding that increasingly it was getting more and more difficult to get everything into that hour and a half that we really wanted to. But equally, to double and say, well, okay, we'll give everybody 3 hours of time was going to make it a logistical difficulty, both for clients and for us. So we decided to split out the review process, and we now do part of it in the workshop. So this is in no way a replacement for the one-to-one meeting. The workshop is there to cover things like the stuff that applies to all of you guys. So all of you that are watching this have investment managers that are portfolio metrics. You have different platforms, you have different risk levels, all of those sort of different situations. But ultimately, we can do the conversation around how the markets are doing. We can do the conversation around how portfolio metrics are doing. We can have a look at legislation changes and financial planning opportunities, all of those sorts of things, plus an update on efficient portfolio in group format. And then when you have that one-to-one meeting with the advisor, it can be specifically focused on what's unique to you and be much more laser-sighted on exactly what you need to talk about. So it's worked brilliantly over the last 3 years. It's been helped by the fact that the market's been up every time I've done this until this year. Whereas this year, we've had a little bit more of a challenging environment from an investment management point of view. But it also, therefore, is a great opportunity to talk about that. And that's what I'm going to spend a bit of time on today is talking about, well, what has happened with the markets, and should we be worried, or should we see it as an opportunity, or what should we be doing as a result of those market falls at the end of 2018? Before I start, I want to just show you one slide. Now, this works really well in seminar format, maybe not quite so well in webinar format, but raise your hand if you saw the duck first. And raise your hand if you saw the hare first, or the rabbit, depending on what it is. Okay, so more people got the duck first. Can anybody not see both yet? Anybody not see both the duck and the rabbit? Oh, yes. But somebody just got it, because yeah, brilliant. So when I first saw this, I could see the duck, but the rabbit just had to really. It was only when somebody said that there was a rabbit there that I could eventually see it. When I showed this to Carol, my wife, and Fionn, my eldest daughter, both of which are very artistic, immediately they said, "Oh, it's a duck and a rabbit." And apparently it shows the creative side of your brain, how strong that is. So they've obviously got a more creative brain than I have, which is not surprising. But what it also shows you is that everything isn't always what it seems. So when you're reading the newspaper or watching the news, particularly around Brexit, just take it with a pinch of salt, because things aren't always what they seem. So let's dive into the details. So I wanted to give you a little bit of an update on efficient portfolio because it's a question that's quite commonly asked at these meetings. So we're growing really nicely. We had a 30% increase on our new business last year, which is fantastic. The previous year was 50%, so we're slightly behind on that year. But 30% growth is certainly not to be sniffed at, and we're growing really, really nicely without it being too aggressively. The team has grown some more. So we've got a number of client relationship managers. So we've now got 4. So Katie typically looks after my clients. Molly typically looks after Tom's clients. Angus typically looks after Henry's clients. Alex typically looks after, Angus also looks after Richard's clients, and Alex typically looks after Tim's clients. So we've got a team there to support you guys, to make sure there's always somebody on the end of the phone or on the end of the email to be able to answer any questions that you've got. The team of financial planners has expanded. So obviously you know me, you'll obviously know your own advisor, but Tom, Tim and Toby are all based in our Rutland office. Richard is based out of Leicester, and Henry is based out of our London office. So the team is expanding and growing, but gradually. And then finally, we also bought a mortgage business 18 months ago. So it's been run by Eric for over 20 years. He's got over 20 years of giving mortgage advice experience. But we'd also got Dan working in Efficient Portfolio, who'd given mortgage advice at a previous company. So gradually Dan is taking over the reins from Eric. So at the moment we've got Eric's wisdom and experience, but we've got Dan's youth and the Efficient Portfolio approach to kind of revamping the way that we give mortgage advice. So if you need help with a mortgage, or you've got maybe a child that needs help or a friend that needs help with a mortgage, then we can certainly help with that. And it's an important point, actually. Part of the reason we did this was because what we found was where people had external mortgage advisors, it quite often then ended up not being joined up with the rest of the financial plan. So you'd come to a client review and the client would say, oh, brilliant news, I've remortgaged, I've got this great, really cheap deal, and they've extended my mortgage up to 30 years. You say, well, okay, that may sound cheap, but firstly, from a lifetime cash flow forecasting point of view, it messes up retirement because that 30 years is now into your retirement. So that's not very good. But secondly, we've done all of this protection work around a 25-year mortgage. If we change that to cover a 30-year mortgage, the protection is going to increase in cost. So whilst they think they've got a nice cheap mortgage, what they find is actually they're going to pay more money in interest over the term and more money in insurance over the term. So having the financial planning and the mortgage advice joined up actually makes much more sense. So we've got these guys there to help you if you need it. Now, we sent you your review pack prior to this webinar by email, and I'd like you to open it now if you can. It's not essential, but it's better if you can look at your version of the charts while I'm going through the generic ones on here. Now, it's worth pointing out that all the charts I'm going to use are genuine data, and unless I tell you differently, they will date back to the 13th of January 2013, because that's the date the Portfolio Metrics portfolios were created in their current format. So if you've been investing with us for less than 3 years, then I would spend far more time looking at the charts I'm going to show you on the screen as opposed to your own charts, because investment data of less than 3 years is pretty much meaningless. The problem with investment data over any shorter time frame than 3 years is that you get too caught up in the peaks and the troughs, because you don't have the time element to let you see what those long-term returns are likely to be. And the best analogy I can give you is if you're going to drive from here to the top of Mount Everest, you know over the course of that journey, you're going to gain altitude. You're absolutely guaranteed to gain altitude. However, if when we set off from Rutland and we head towards London, which feels like it should be downhill, it is downhill, it doesn't mean that in the long journey, we're still not going to gain altitude, because we are. But we're going to go through some dips and we're going to go through some climbs, but ultimately we're likely to end up much higher up. So bear that in mind. So in your Efficient Portfolio Summary, which is the main document we've sent you, you'll notice that it opens with a few pages that look like this. The first page is your investment valuation. A few key things to highlight here. First is your the type of investment. So this will be your things like your ISAs, PIPs, general investment accounts, those sorts of things. Total amount of money invested, any withdrawals. You'll see your risk score. It's worth making a mental note now what your risk score is, so that when we talk about risk later on, you can remember what your risk score was. Actually, I should have said, by the way, if throughout this you've got any questions, you can post those questions in the support panel, and I will try and answer them as long as I see them promptly. but I'll try and put that obvious so that I hopefully do. So we've got, and then we've got the value as of last year and the value as of today. So that just gives you a nice summary of all of the investments outside of pensions that we manage for you. A couple of extra things on this page that are really important. Bottom of the page will highlight your ISA allowance. Now, it's a really valuable allowance, which I'm going to come on to later on, but we'll highlight how much is left. Some of you may end up with a random number like £500 or £2,000, and you think, well, that's a bit strange because I thought I fully funded my ISA at the start of the year. Because if you've already got a PIP and an ISA, we will have been in contact at the start of the tax year, and we'll again do the same at the start of next tax year to say, do you want us to fully fund your ISA from your PIP? And we do that, and we take the full 20,000. However, there are different fees that come out of that account over the course of the year, which means that actually by the end of the year, there is a little bit of space left in that ISA allowance because we can actually fund up to the full amount, eliminating the fees that have been paid. So we'll have made a recommendation, and I'll come on to those later on, to just fund that last little bit, that last little £1,000 or whatever it is, from PIP to ISA, assuming that's applicable to you. Second, two things to point out here are that in the top left-hand corner, you'll see we've put your client relationship manager, the person that you should generally go and speak to, email, pick up the phone to if you've got any questions. They're in the office permanently. They'll be there to deal with it. And if they can't answer the question, they'll obviously go to your advisor. Then your one-to-one advisor is up here. Now, for many of you, that'll be the advisor that you've always seen. For this year, we're changing it slightly for those clients that I've historically looked after, because I'm still overseeing all of the recommendations and working with the other advisors to build those recommendations. But because of the sheer number and as also as a result of the efficient portfolio growth, on some of those one-to-ones, I'm asking other advisors to do those for my clients. If that applies to you and you've got any issues with that, or there's a big change happening in your finances and you think you want me to help you with that as well as that other advisor, then just tell us. Clearly we don't want to cause any issues, but when we've tried this with other clients in the past, it's worked really well, and ultimately it allows you to have more direct access into the financial planner because those guys have got a bit more time than I have, and it'll just give you a bit more access. And ultimately what we're trying to do is deliver as much value as possible to you guys. So just worth looking at your own document to check those bits there. The next page is then a similar page that covers off pensions. Again, similar format, make a mental note of the risk score, today's value, last year's value, total portfolio value down here. Couple of other things, or one other thing to mention on this page is we will have put a piece of commentary around your platform. So your platform is likely to be a WealthTime, Praemium, or a Transact. Those are predominantly the three platforms that we use. Predominantly, it's actually WealthTime and Praemium, and Transact is there for us a few specific reasons. When the other two don't work so well. We're really happy with those three platforms still. We still can't find three better platforms than those, or any better platforms that we'd rather be using that would link up to portfolio metrics as well. So we've not made any recommendations to change that at this stage. And we're still really happy with the charging structure as well. It's still very, very competitive. Following this page is two other similar looking pages. One that shows you any life insurance and protection products that we organise for you. Where we do that, we'll also show you a column on the right-hand side that shows you what the replacement cost of that would be today. So if, for example, you've got a life insurance policy that costs you £50 a month, we'll show you if we were to go off and replace that today, whether it would cost you more or less than the £50. If it's green, it's cheaper, and we'll no doubt recommend later on that you change that. If it's red, it's more expensive, and probably you'll want to leave as is. And then there's a page that just details all of your estate planning. So whether you've got wills, trusts, lasting powers of attorney, those sorts of things. And I'm going to come on to talk about that a little bit more later on. As you go through your pack, you'll then see your lifetime cash flow forecast. Now, it's worth just reminding you what that lifetime cash flow forecast is telling you and explaining the charts again. because you probably haven't looked at this for a year. And for some people, it just becomes a little bit challenging to remember exactly what they're seeing. So there's two key charts in the lifetime cash flow forecast. First one is income versus expenditure. And this is two examples of what that might look like. Now, firstly, hopefully you'll remember we generally model everybody to age 100. And what you will see is these blue blocks are the amount of income you've got available to you each year. The black line is the expenditure that we've modeled for you for each year for the rest of your life. And blue is good. It means that you've got enough income to meet your expenditure all the way through your life. Red is bad. Red highlights the fact that the blue blocks are not sufficient to meet your expenditure. So red is highlighting a shortfall. Blue is highlighting that you've got sufficient income for each year. So this is just your income versus your expenditure. But then we also need to look at the liquid assets, which is what's going on behind the scenes. Are your investments rising throughout the course of your life, or are they falling? These two scenarios actually relate to one another. So the reason that this person was running out of income is because he spent all of his money. The reason this person had enough income was because he had his investments were continuing to grow. So this person might be thinking more about inheritance tax planning or spending more or retiring earlier. This person may be saving more, retiring later, spending less. But the lifetime cash flow forecast is such a powerful tool. And I really encourage you to use this as much as possible. Now, prior to this webinar and prior to each year of client review workshops, we'll send you out a form to complete. It doesn't have to take very long, but it's really important because it allows us to get an updated picture of your situation. And also it allows you just to kind of scan over the data that's going into the lifetime cash flow forecast, because there's nothing more frustrating than looking at the lifetime cash flow forecast and, well, why has this got me as a shortfall? And then looking at it and going, oh, well, that's because they haven't included this, or that I don't have any more, or they haven't, the bits that are wrong. So much better is that you scan through our assumptions prior to the client review workshop, send it back to us. We'll then make sure that the lifetime cash flow forecast is accurate and up to date. And then what you see in the workshop itself will be far more meaningful. The other benefit of doing that form is that you can complete a section that tells us what scenarios would you like us to model. What scenarios do you think, are you thinking about buying a house? Are you thinking about private education? Are you thinking about retiring at a different date? Whatever is going through your mind from a financial perspective, or even really from a life perspective, if there's a financial impact, we can usually model it, then tell us. Put on that pre-workshop questionnaire what you'd like us to model. As long as you give us some background as to the financial impact, and if you don't, we'll no doubt ask for it anyway, then at that stage, you'll be able to see, when we send you your workshop pack, those what-if scenarios and talk them through with your advisor at the one-to-one meeting. Also, if something's cropping up in the middle of the year, don't wait to the workshop to do this again. So if you've got a big financial decision that's cropping up in the middle of the year, send an email through to your client relationship manager to tell them what's going on, and they can then try and remodel that lifetime cash flow forecast to help give you some more information so that you can make the best decision possible. Because ultimately, all this is doing is giving you the clarity of the impact on financial decisions that you make today. So the market, you knew we were going to have to cover it. It's definitely a talking point at the moment. So what's going on? Well, when we send you your quarterly report, quarterly portfolio analysis, you get the first chart within that is this market conditions chart. And I always tell my clients, every time we send you this document, just to open this, even if you only spend 15 seconds on it, this is one of the 3 pages just to glance at. Because what this does is it gives you context. Now you can see that, so what we're looking at here is how each of the different areas that you can invest in, and you're invested in every one of those areas through a portfolio metric portfolio, with the exception of direct investment into commodities. You still have indirect investment into commodities, because obviously investing in a company like BP, will be impacted on whether oil prices are high or low. But there's no direct holdings in commodities because Portfolio Metrics believe it's a better portfolio without that. And actually, over the 6 years that they've been managing money for us, they've been proved right. But what this is looking at, for each of those areas that we can invest in, how did they do over the last year, over the year before that, and also the last quarter? So what we can see here is in 2017, pretty much everything was up, which means that 2017 would have been a good year to be investing, and the portfolios are likely to have done well. 2018, which is light blue, nearly everything was down. And in fact, last quarter, nearly everything was down. So as a result, we can expect that the performance is going to be poorer when nearly everything is down, except for those lower risk assets which are designed to protect the portfolio, and I'll come back to those in a minute. Really, everything was losing money in 2018, and particularly in the last quarter. So we can't expect the portfolios to have done well because clearly, if everything that you invest in is going down, then it's going to be pretty challenging to make profits. To look at it a different way, this is the world index in red, the emerging markets in green, the FTSE 100 in blue, and the bonds and fixed interest in purple. And you can see they held their value, but everything else has lost money over 2018. So what's going on? Well, I'm sure you're sick of hearing about it, so I'm not going to dwell on it for a long period of time. But clearly Brexit is having an impact on the markets. Markets don't like uncertainty, and Brexit brings uncertainty in huge doses. And as a result, when we start to see any positive movement with Brexit, and it looks like we're not going to get no deal, which I suppose is the greatest dollop of uncertainty we could get, then the markets respond positively. But the markets have definitely already priced in that no deal is a significant risk. And so if we do find a deal with Europe, subject to some negotiating, I read a funny post yesterday that said, we're going to go back to Europe and speak slower and louder until they understand exactly what we want, which made me chuckle. But ultimately, if a deal is struck that avoids a no deal, then that is going to create a lot less uncertainty in the market. And as a result, the markets will probably respond very positively to that, because, as I say, a lot of the doom and gloom is already priced in. But who knows what's going to happen over the course of the next 2 weeks? I don't think anybody really knows. Our friend over the pond is obviously causing slight chaos in the US. Now, the US is an interesting topic. Portfolio Metrics have undervalued, gone underweight in US, which is certainly something you wouldn't describe Trump as, I know. But they've gone underweight in US holdings for the last year. And to be honest, that's probably caught them out a little bit. They feel that the US is overvalued at the moment. If you look at price earnings ratios, then the US is valued close to pre-technology bubble levels. And so they're worried that the US is overvalued, and so they're underweight US at the moment. Now, I think they maybe have called that a little bit too early, and I think that's maybe affected their performance a little bit over the last year. But the US has done extremely well in recent years, and so having a strong bias towards US investments has helped some funds, and a weaker bias to the US has slowed some down. Ultimately, we'll only know in the next year or two who was right. But certainly Donald Trump's attitude to the world and attitude to the US and the longest shutdown in history is again causing more uncertainty, and also the figures that are coming out of the US are starting to look less favourable now, so maybe Portfolio Metrics have called it right. Clearly Europe has its issues, Brexit of course being one of them, but it looks like Germany is slipping into a recession. Certainly France has got issues with rioting. We had the debacle over the Italian budget. There is significant issues in Europe too, and again, I think that if Brexit was all ironed out, then we would see some more positive returns there. but the Germans slipping into recession is certainly worrying for Europe. Probably the bigger concern is the trade war between the US and China. That probably as an investor is the biggest worry, actually, because it's the most global one. Obviously it affects the US. It also very heavily affects the emerging markets. But again, if a good trade deal was agreed between the US and China, there's definite potential for upside growth, but there's of course potential for more concerns there too. Ultimately, we don't know what's going to happen. And every year that we do this workshop, there are always certain things that are there to be worried about. And also those same things are often opportunities too. But if we look at the markets, we can see, well, actually, again, the FTSE and the world market both fell over the course of the year. FTSE marginally more than the world market. But if we go back 3 years, actually, so now 4 years, then we can actually get a much better picture. The reason that this one doesn't go back quite as long as the 6 years that I try and use always is because one of the holdings in the portfolio didn't exist 6 years ago, so I can't do this type of reporting any further back than December 13. But ultimately what you're looking at here is the FTSE 100 compared to the Portfolio 5 from Portfolio Metrics. So Portfolio 5 is 63 on the risk scale, just to give you some context as to how that relates to your own risk score. But when I speak to my clients about investing in a diversified portfolio, I'm always saying that really the benefit of investing in a diversified portfolio is hanging on to the coattails of the market in an upward trend, protecting in a downward trend. It won't stop the portfolio falling, but ultimately what you're trying to do is fall less than the market so that when the market rises, you can outperform. And really, it's actually in these times, these downturns, these downward trends, that you get your long-term outperformance. It's not so much in these growth periods. You'll notice that, like for example, this fall here is much smaller than the FTSE fell. Again, here it's smaller than the FTSE fell. Here, smaller than the FTSE fell. This probably being the most obvious one. So ultimately, the portfolios are doing what they were intended to do. They're generating growth when the markets are up, and they're protecting when the markets are down. And in fact, a better way of looking at that over the course of 2018 is this. So these are the blends of 7 different levels of risk, so 1 through to 100. So 1 out of 100 and 100 out of 100 is light being 1 out of 100, dark being 100 out of 100. You can see that in the fall, around the start of 2018 and the fall towards the end in the last quarter of 2018, those portfolios provided significant protection over and above the markets. And actually, it's worth saying that we keep a constant eye on those 7 different levels of risk, because we know that everyone is somewhere between those. So if we keep tracking those 7 different levels of risk, so 1 out of 100, 100 out of 100, and 5 stops in between, we know that we can know what's happening to everybody. And ultimately, the portfolios are doing what they're supposed to do, despite the fact that the market is working against us. Slightly different way of looking at it. So in the market drawdowns, when the market has fallen, how have the portfolios protected? And you can see that they've provided significant protection in those drawdowns. And upside of investing, so if we go back to January 2013, we can look at using this chart how it's performed, how each of those have performed compared to the FTSE 100, and you can see that a risks, the returns. So what would that be? So that would be risk level about 45. So a portfolio of 45 has given the same long-term returns as the FTSE, but giving you significantly smoother returns as well. And I really like this chart. I really like this, what this shows us, because what this is looking at is, and this was done by Dimensional, by the way, who are a passive fund provider. What it looks at is the number of patents that have been applied for since 1970 per annum, number of patents that have been granted each year since 1970, and the world market in the background. And what you'll see is, as the number of patents applied for has risen, so has the number of patents granted, unsurprisingly. So what's that telling us? We're thinking of lots more things than we ever thought of before, and we're creating more things than we've ever created before. And guess what? As a result of that, the markets are continuing to rise. Now, of course, within that, we still have market crashes like the technology bubble, like the credit crunch. But those aside, long term, we are likely to continue to think up more things, build more things, and as a result, long term, we're likely to continue to see more growth. Clearly, I couldn't say that we're guaranteed to get long-term growth, but I'm pretty confident that that's likely to be the case. I'm also pretty confident that there's going to be market dips within it at times. And in fact, the dip that we've just seen at the end of last year is actually the second smallest dip since the credit crunch. It's not the biggest dip that we've had since 2008. Last year as a calendar year was the worst year that we've had since 2008. But the dip at the end of the year wasn't, it's just the fact that the timing was right at the end of the year that it made it the worst year since 2008. But it does play around with your psychology as an investor, particularly for those of you that haven't been invested in this approach for very long. You may have only just had a short period of growth and then watched your investments fall. And it really does mess with the mind. But ultimately, what you've got to do is have the resolve to say, well, look, I know it's here at the moment, or we don't even know. It could be here, for example. Ultimately, in the long term, what we're likely to see is something like that. And what we're therefore likely to see is an expected return. And that's why I say that anything less than 3 years really is meaningless, because we get too caught up with whether it's up here or whether it's down here. But by looking from 3 years or longer, then we can start to see that smoothing effect, that long-term return. And that's what you'll see with the charts that I'm going to come on to when we compare how portfolio metrics have done for you against inflation and against their competitors. Because ultimately, time in the market is better than timing the market. It's been proven countless times it's impossible to time the market. It's impossible to predict when we're at the market high and predict when we're at the market low. And Warren Buffett, the world's most successful investor ever, has managed to fail to time the market nearly as many times as he's got it right. So it really isn't possible to time the market, and therefore the best thing to do is to put the money into the market and let the market work its magic over time. And the best example I can give you of that is that if we took your investments or took an investment that have invested for the last 42 years, and within those 42 years, you missed the best 10 days. So 10 days out of 42 years, you missed. Well, that would have delivered you 50% less growth by just missing 10 days. So if you try and time the market and try and not put money in because you think it's not a great time, you end up missing those best days, because you almost always only ever end up investing just after things are picked up, even if you're fairly quick about things. And as a result, you miss those best 10 days and you give up substantial amounts of your returns. And I suppose this is just another way of looking at it. We've had all of these dips before. We've had things like the dot-com bubble. We've had the credit crunch. We've had other crises along the way. And this is just another bump in the road, I suppose. And really, the two messages I would leave you with today, and obviously I'm not at the end of this webinar, so don't worry, but the two strongest messages I could give you are, firstly, that time in the market is better than timing the market. But maybe even more importantly than that is the key to long-term success or long-term growth is withstanding short-term losses. And I'll repeat that one again. The key to long-term growth is withstanding short-term losses. And as long as you withstand those, let the market work its magic, then you'll see some longer-term growth. So what's going to happen with the market ahead? Well, nobody knows. and anybody tells you they know, I'd walk in the opposite direction. All we know is that there'll definitely be another market crash at some point in the future, and we just don't know when and how big or what's caused it. They say that, there's a saying that economists have predicted 9 of the last 2 recessions, and that, there's always lots of people out there predicting doom and gloom, and occasionally they're right, and then they get held up as geniuses. But ultimately, nobody really knows what's going to happen with the market ahead. So the best thing to do is to stick with a diversified portfolio, stick with the strategy, and see it through. And that long term is likely to generate the sort of returns that we've told you about. So we want to look at now how portfolio metrics have done. And the way that we want to do that is to look at portfolio metrics compared to all the discretionary investment managers in the world out there in the UK, or nearly all of them. All of them give us access to the data. And then all of the fund managers are out there. So the discretionary managers are people like UBS, Coutts, Investec. The fund managers, and also it's worth pointing out, are seen to be the best of the best. They're certainly the most expensive solution out there. And then the fund managers, people like your Jupiters, your Newtons, your Invesco Perpetuals, all of those sorts of guys, we want to be comparing against them too. And the best way to do that is with this type of charting. Now, if you've been coming to these client review workshops for a while, or been speaking to me about performance for a while, you'll hopefully be on familiar ground with this type of charting. But for those that you are seeing this for the first time, it's worth explaining. So what this is looking at is the level of risk compared to the level of annual growth. And what we want to see is up and left is good. So ideally, you want 12% a year growth with 0 risk. Sadly, that's not possible. So what we expect to see is the more risk you take, the better the returns you get in the long term. So this blue line is portfolio metrics. That level's 1 out of 100. That's 100 out of 100, and these are 5 stops in between. That's the 63 portfolio 5 that I'll keep referring back to. Purple line is the discretionary managers. So that's the 4 different categories of risk for discretionary managers. And then the orange line is the fund managers, again, put into 4 different categories of risk for all of the different diversified fund managers that are out there. So what we can see here is that over the last 3 years, which is the minimum viable data worth looking at, portfolio metrics have delivered somewhere around 7% growth per annum. The average discretionary manager out there has delivered around 5% per annum, and the average fund manager a little bit less than that, maybe 4.7%, something like that per annum. So over 3 years, portfolio metrics still looking fantastic. Over 5 years, they look just as good. In fact, maybe they even look slightly better, but the scale has changed here. So it's still about maybe a little bit over 2% per annum better growth than the average of both the discretionary managed world and the fund managed world. So for the 2 timeframes that are most meaningful, we're really happy with the performance they're delivering. Over the last year, we're a little bit less happy. As I said, anything less than 3 years is not really meaningful data, but it's still good to keep your eye on what's going on. And whilst they've done better than most on the lower levels of risk, on the higher levels of risk, actually some of the fund managers and discretionary managers have managed to outperform them, and they're a bit under the average on those highest levels of risk. So this is worth keeping an eye on. Different way of looking at this is a scatter approach. So this is looking at the different competitors that we could be using instead. And what you can see here is over 5 years, they look fantastic. Over 3 years, they look fantastic. Over 1 year, bit more average. So again, we need to keep an eye on that. And then what we do is each quarter, so we do all of these charts and every quarter. But what we also do every quarter is we pick 35 leading competitors, and we've assessed how portfolio metrics are doing compared to them each quarter. I just want to go through a handful of them, not them all by any means, but just to summarize. So this is 7IM. So this is Justin Urquhart Stewart, the guy with the red braces on the BBC quite often. That's his discretionary managed firm. So if you remember that up and left is good, then hopefully that'll allow you to see what we're pointing out here. Blue will always be Portfolio Metrics and red will be the competitor. So compared to 7IM, Portfolio Metrics have done really well. Compared to Aegon, they've done well over 5 years, pretty well over 3 years, a bit closer over 1 year. BlackRock, again, Portfolio Metrics have done very well over 3 and 5 years compared to them. Over 1 year, there's some weird things going on with their risks management here, but ultimately they've probably done slightly better than Portfolio Metrics. Brooks Macdonald, again, Portfolio Metrics have done far better than them over 3 and 5 years. Over 1 year, Portfolio Metrics have underperformed Brooks a bit. Interestingly, when we were going off and doing a big change away from picking the investments ourselves 6 years ago, Brooks Macdonald were the other people we narrowed it down to. They were the leading contender with Portfolio Metrics to manage our clients' money 6 years ago. So picking Portfolio Metrics compared to Brooks Macdonald has proved to be absolutely the right thing to do. But as I say, over the last year, the performance has been a little bit better, so we need to keep an eye on that. Close Brothers, over 3 and 5 years, much better, being in Portfolio Metrics. Over the last year, they've actually done quite a good job of protecting their clients. Cornelian, inferior to Portfolio Metrics. Fidelity, similar story, better. Portfolio Metrics better over 3 and 5, but over 1 year, Fidelity looking better. Goldman Sachs not looking as good as Portfolio Metrics. Jupiter, similar story, 3 and 5 years, PMX are better, not so over 1. M&G, not looking so good. Old Mutual, not looking so good. Quilter Cheviot, not looking so good. Royal London, they've done a pretty good job actually. Over 3 years, 5 years, their risk management is slightly skewed. They're not managing to control risk in the right way, which is worrying. But over the year, they've done actually a good job of protecting clients. Over 3 and 5 years, Scottish Widows have lagged behind, but they've not done a bad job over 1 year. St James's Place, really tight risk spread, but they've done an okay job over the last year, not so much over 3 and 5. Now, this is the last one that I want to talk about, but it's one that I want to highlight particularly because we've been doing this reporting every quarter for the last 6 years, and this is the first time, the first quarter that we've found a company that, looking back over this specific time frame, that have outperformed Portfolio Metrics over 3, 5, and also 1 year. Now, interestingly, if you look at 2 years and 4 years, Portfolio Metrics have outperformed Vanguard. So it's not all as this would seem. But it is the first time that we see a viable competitor to Portfolio Metrics. That said, it's the first quarter in 6 years that the numbers have worked so that they would be a viable competitor. And as a result, we'd be completely crazy to recommend everybody switch from Portfolio Metrics to Vanguard now. If you look a bit deeper, Vanguard has got a very strong weighting towards bonds and US equities, 2 asset classes which have done very, very well over the last few years, but 2 asset classes that look, as Portfolio Metrics have already talked about, overpriced at the moment. So when something's overpriced, it's always going to look good, but we don't want to switch strategy to something when it's at the top of the market. But it's certainly interesting to see that this has happened. And as a result, my own pension, my own ISAs, my own children's junior ISAs are all still invested by Portfolio Metrics. I'm not changing strategy myself, and I wouldn't recommend anybody else did. But our job is to keep looking. And ultimately, if a year from now, this trend has continued, then maybe that's something that we would consider. The great news is, because you're on an independent platform, if we decided to make that switch away from PMX to Vanguard, which we probably won't, but if this continued, then we might do, then it would be pretty much cost-free and admin-free and really easy to do. And it would happen over the course of a few days. It wouldn't be a difficult thing to engineer, and it wouldn't be a costly exercise to engineer. So that's the beauty of having that independent platform. So I suppose the message is we're keeping an eye on it to make sure that if we can ever find a better investment strategies and portfolio metrics, we'll be the first to tell you, because we'll be wanting to do it for ourselves as well. It's not just me, all of the team's pensions are invested in portfolio metrics. So we'll keep an eye on it and watch this space, but we'll certainly continue to do this reporting to check to see if we think we can find anything better. If you go back to your client review pack, you'll also see in there your target asset allocation and your current asset allocation. That's the split of your investments. They'll never look identical. Quite often there'll be a little bit more cash than is the target, and that's because quite often if you're putting monthly contributions in, or if you're taking monthly contributions out, or there's a fund switch just recently happened, then you'll find there's a little bit more cash. But they should look pretty similar. And obviously, if they look wildly different, then something's going wrong and you need to let us know. List of the investments that are in your portfolio at the moment. You'll see some familiar names in there, including Vanguard Holdings. So Vanguard are passive funds that just follow the market. So they are actually in your portfolio as well. But from some familiar names like Fidelity as well, and some probably less familiar names like, for example, Somerset, who specialise in emerging markets, PIMCO, who specialise in fixed interest. Now, I said when we send you your quarterly investment review, you could do it, you could look through it in just 15 seconds. And I pointed out that the market outlook would be the first thing you look at. Second thing you should look at is this chart here. Real growth. So what growth are you above or below the line? Because everybody always asks us, how much money have I put in and how much is it worth? And what this chart is trying to do is give you the transparency on that information. Because ultimately, what we find is that very few providers in our sector deliver that information, but it's the bit that most people want to know. So your chart has a black line that runs through it, which is money in minus any money out. So if you're making monthly contributions or lump sums, it will be notching up. If you're drawing an income, it will be notching down. Hopefully that will make sense for you, because ultimately it's about when you've put money in and taken money out. Behind it is the value of your investments. Now yours will look slightly different to this. You'll have different colors and they'll be in different size blocks, because one will represent your ISA, one your pension, one your PIP, and any other accounts that you've got. But ultimately, if you're above the line, then that is all growth over and above what you've put in. If you've started investing more recently, so let's say you only started investing through us at the start of last year, then you'll probably find you're maybe just under the line a little bit, and actually your money's worth slightly less than you put in. For the reasons I've already explained, don't panic, because, as I say, the secret to long-term growth is withstanding short-term losses. But ultimately, we're trying to give you the clarity, as much clarity as possible, on whether your money is growing because you're putting more money in, or whether it's genuine growth as a result of the investments. The next chart, which you can skip over in your 15-second review once a quarter, just shows you the performance of each of the individual accounts. It's useful if you've got different levels of risk or the investment started at different times, but for some of our clients, these will all look pretty similar. So I would skip through to spending the final part of your 15 seconds on looking at this chart. Because what this chart is doing is it's taking all of your different investment accounts and saying, right, from the day that you started investing with Portfolio Metrics through to today, what's the performance been like? And what's it been like compared to what we told you to expect? Because when we did your financial plan, we would have given you an expected growth rate. And that expected growth rate is a growth rate plus inflation. Because we have to focus on this growth rate plus inflation, because it's no good saying, oh, we got 12% growth, isn't that fantastic? Because if inflation was 14%, you just lost 2% of your money. Equally, 1% may not feel much growth, but if we're in a deflationary environment and so negative 1%, then you've actually had 2% real growth. So growth over and above inflation is a really important thing to look at. And so in this example, you can see that inflation, which we assume at the moment to be 2.25%, plus 3% was the expected return for this portfolio. So 5.25% after fees is what this portfolio should be delivering. As I said, this is genuine data that dates back to 13th of January 2013. And is a blended risk approach, so it would come out of pretty much, I would think, around about 50 out of 100. And then the actual returns that they've experienced are on the blue line. So you can see at stages they were under the expected return, but even now after this dip we're still above the expected return. In fact, we can drill down a little bit and say, well, what we expected over that time frame was 31.3% growth. What we actually got was 34.7% growth. Now, of course, at the start of last year that looked a lot more rosy, but we hadn't just had a market dip, and hopefully we'll go back to those levels at some point in the not too distant future, and it will all look even more rosy again. But ultimately, over the long term, despite the dips that we've had, we're still getting more growth than we expected, which is the important point. And so, as I say, each quarter, if you just look at these three sections, the market outlook, the above or below the line chart, and the consolidated performance, then in 15 seconds you can get just a clear picture on what's going on with the market, how are my investments doing compared to what I've put in, and how they're doing compared to what I expected to be doing. And then if you're not seeing what you hope to see, then you can go back and spend a little bit longer reading the explanation from Portfolio Metrics. Maybe send an email to your advisor or your client relationship manager if you're worried. But in that 15 seconds, you should be able to get a pretty good idea of what's going on. And I just talked about expected return, so it's worth looking at, even at this time of markets being a bit lower, how Portfolio Metrics have performed compared to what was expected. And what you can see here is, so this is the expected return for those 7 levels of risk, and this was the actual return received. So any risk level from about 45 and upwards has delivered as good as, if not better, growth than was expected. But below 45 on the risk scale has started to underperform what was expected slightly at this moment in time. It's partly because interest rates have remained very low, and the lower the investment risk, the lower or the larger the percentage of cash and stable assets, and in a low interest rate environment you'd expect those to be generating less returns. Because in these are assumptions assuming long-term growth rates, which cash would be, you'd assume over the next 10 years that it would generate you more than the 0.75% it would get you today. But I think it's just interesting to see that. And one other thing that we look at again every quarter is Portfolio Metrics' active approach still the right approach? When they're picking funds which cost you more in charges, but that they think are worth paying to try and beat the market. So when they're picking a UK fund to try and beat the FTSE 100, are those picks actually proving sensible? Are you getting value for money? Because it's costing you a little bit of extra in fees, but are you getting better returns after those fees? So what this chart shows you is a level of risk of just the FTSE 100 blended with cash. So that's the same risk level. This is then the passive approach. So this is a bit like the Vanguard approach, I suppose. It's all passive investments. It's just following the indexes, but it's split in exactly the same way as the Portfolio Metrics core approach. So if this was 25% in UK stocks and shares, this would be 25% in a FTSE tracker. Split in exactly the same way. And then this is the core approach, which is the approach that pretty much all of our clients are on with Portfolio Metrics. So typically that'll be about 80% active funds and 20% passive funds, where you saw things like Vanguard and iShares in the portfolio. So what you can tell from this is that even though these two levels of risk have exactly the same split of investments, after fees, which is an important point, so after fees, this core approach delivered roughly 2% extra growth per year. The margin gets less, the less risk you take, but even at the very lowest level of risk, after fees, it's delivered slightly better growth. And as a result, that shows that Portfolio Metrics are delivering better returns as a result of picking the funds that they're picking. But what's also interesting is you'll notice not only that was that dot above this dot, it's also to the left of this dot, which means not only did them picking the right funds deliver an additional 2% growth per annum, it also meant that it gave you less risk. So you actually ended up experiencing less risk and better returns, which has got to be a good thing. Now, one other thing that's really important to do each year is to assess whether you're at the right level of risk. I asked you to remind yourself of what that was at the start of the workshop. And so what I wanted to do, I mean, you can see that the more risk you take, the likelihood is that the better the returns you get. That's certainly what we've seen so far. Actually, I've just noticed that this chart is slightly out of date. This is so that's why we haven't got the little dip at the end here. Ultimately, you've got to pick a level of risk that's comfortable for you, because if you take too much risk, then you end up making rash decisions when the markets are down, because you can't cope with the volatility, how bumpy the road is. But also, if you take too little risk, you're almost guaranteeing too lower returns, and that can mean, depending on your cash flow forecast, depending on your situation, guaranteeing the fact that you run out of money later on in life, which clearly you want to avoid. So it's useful to just look at what different levels of risk portfolios look like and just compare a little bit. So for example, 20 out of 100 risk level it's nearly got half in cash and stable assets. So in a low interest rate environment, that's not delivering very much, but it is underpinning the portfolio. You've got a good chunk, probably nearly a third, in bonds, which are medium to medium low risk investments, because they're loans to companies and loans to governments. And then you've got a bit less than a quarter in stocks and shares. And you'd expect a growth rate of inflation plus 2.34%. If we shift up to 40 out of 100, then you can now see the cash and stable assets has dropped down to a bit less than a quarter. You've got about a third in bonds and stable assets, and you've got about a third again in equities now. And you're expecting somewhere around inflation plus 3.1. At 60 out of 100, we're starting to see that cash and stable assets has dropped down to just 5%. Still got a good slug in bonds, although it's starting to reduce. And we've got well over half the portfolio now in stocks and shares, including, for the first time, we've seen property come into the portfolio. It's also an interesting point to show you where Portfolio Metrics believe property is on the risk scale. And we'd now expect inflation plus around 3.86%. And then finally, if we go up to 80 out of 100, we've lost the cash and stable assets. The bonds are starting to drop down, and in fact, we've lost government bonds, which are the lowest risk form of bonds. And we've got over 3/4 of the portfolio is in stocks and shares. And we've now got nearly 13% in emerging markets. So it's all still very well diversified, but ultimately it's likely to deliver you more like 4.5% growth over the long term. But it will be a more bumpy ride. So it's just worth thinking about what your risk level is. And in your recommendations page, which I'm going to come on to in a minute, we'll have suggested, unless you've done it just in the lead up to the workshop, that you think about redoing the behavioural finance questionnaire so that we can reassess your risk score. It's not something you need to do every year necessarily, although if there's anything changing in your situation or your mindset towards investing, it's really worth redoing that, because we can then adjust it and you make sure you're in what we call the green zone, which is the right area given your answers to the risk score. So what changes and opportunities are there out there with regards to financial planning? Well, I've already talked about the core portfolio metrics approach, which is about 80% active funds, about 20% passive funds. And they've also got a passive approach, which I've already talked about as well, which is to say that it's exactly the same splits, but it's all passive investments, so funds are just following the market. But in addition to that, there are some other strategies. One that I just wanted to mention was an ethical portfolio. So you can switch some or all of your money into ethical portfolio metrics portfolios. So that means that they screen out any funds that invest in unethical, for want of a better phrase, companies. Things like tobacco, things like firearms. And as a result, what it does is it limits the number of funds that they can pick, which ultimately increases risk. But it means that you're investing in more socially acceptable areas. Now, because it increases risk, I'd be reluctant to say switch all of your money into ethical portfolios. But it doesn't have to be an all or nothing thing. So, for example, if you did decide that you wanted to put, for example, your ISA into an ethical approach, but keep your pension as a traditional core approach, then it's perfectly possible to do that. And if that's of interest, speak to your advisor at your one-to-one, and you can implement that fairly easily. As I said, there's actually a number of different strategies within the portfolio metrics world. We keep a constant eye on this. So we look again every quarter, we're looking at how each of these portfolios did compared to the others. So make sure that our clients are on the best strategy. Core active has been long-term the best approach. This enhanced indexing was interesting. It was doing very, very badly in 16 and 17, but in 18 it actually did quite well. So we'll just keep an eye on this, and if at some point we think there's a better strategy within the portfolio metrics arena, obviously we'll be telling you about that too. Another big financial planning opportunity is really your pension allowance. It is such a valuable allowance now. There's two allowances to think about really. One is the annual allowance, which is £40,000. But if your total earnings, including your pension, rises above 150,000, it starts to drop down and can drop as low as £10,000. That allowance is really, really valuable. The second allowance that is for your pension is what's called the lifetime allowance. It's the maximum you can put in to get the tax breaks from pensions over the course of your lifetime, and it's at the moment a little over £1 million. I'd see that £1 million lifetime allowance as a target, not a limit. It really is such a valuable allowance, not just from an income tax point of view and a capital gains tax point of view, but also from an inheritance tax point of view. The pension is the best tax wrapper that we have out there. And as a result, you really want to maximize it. And particularly if your earnings are starting to rise up so that you're likely to earn more than £150,000 in the future, or you already do, you really want to be looking back, because you can also claim back, you can invest the last 3 years of allowances. And if your allowance in the future is going to drop to just £10,000 a year, you're not going to be able to get much money into your pensions in the future. So if you've got previous allowances that would facilitate a larger contribution, you really want to be using them up while you can, because those previous years will drop off as you carry on earning more and more. So those pension allowances, as I say, it's £40,000 unless you earn over that 150, and then it starts to drop off. But we can calculate what the maximum amount is, and even if you were taking money out of ISAs or other investments to fund that pension now while you can, knowing that in a few years' time you'll be restricted, I'd see that as being sensible financial planning, because it is the most tax efficient wrapper, subject to your situation, of course, which is worth talking through with your advisor. There's also a reduced dividend allowance. So for those business owners out there that are drawing their money out as dividends, the amount that you can draw out without paying tax has fallen. And so as a result, one way that you can combat that is to put more money directly from the company into your pension. It's just a good way of mitigating that extra tax increase. Probably the second most important allowance out there is the ISA allowance. You really want to be using that up each year, £20,000 each. If once you've done the pension, or with money that you need access to in the future for things like school fees or whatever it is, then ISA allowances are far away the next best tax wrapper. And if you can get to retirement having got a lump of money in pensions and another lump of money in ISAs, it puts you in a really strong position, because you can draw some money out that's taxable and then top up to the level of income you actually want from something that's tax-free, to mean that you can avoid paying any tax at all or any higher rate tax, depending on the sort of levels that you're talking about. We've got clients in retirement that are drawing over £100,000 a year in income that are paying zero income tax, because we've got these different tax wrappers utilised well. Now, if you have a PIP, so a portfolio investment plan, otherwise known as a general investment account, so an investment that's not in your ISA and or your pension. So if you've got a PIP, then one thing that we'll be writing to you around the start of March about is called capital gains tax harvesting. It's just worth trying to lock in some of the gains that you've got in your portfolio. Otherwise, what happens is the gains build and build and build, and if you wanted to take cash in your whole portfolio in years to come, then, or take a significant, you got a significant year of growth, then you'd be paying more capital gains tax. So if we can rebase that portfolio each year and use up each year's capital gains tax allowance, because it's an allowance that most people aren't using, it makes sense. So we'll write to you in March, something to watch out for. But if we get this bit right, we can eliminate a lot of we can save as much money as you'd be paying in investment fees within your plan. So it's a really nice saving each year to pick off and to use that capital gains tax allowance up. So watch out for that. Another thing which is really relevant to business owners, so for any of you that are watching this that are business owners, or for any of you that have children or friends that run their own businesses, relevant life cover is a great way of having life insurance, but far more cost effectively. Nobody likes spending money on life insurance, and let's be honest. So anything that you can do to save roughly 30% of the cost purely through tax breaks has got to be a good way of doing this. And relevant life cover just allows you to take, instead of having personal life insurance, which is paid out of net money, you can put it through your business, and it comes out of gross money, and it's not a benefit in kind. So in other words, you're saving a significant amount of tax by paying for it through the business. So if that applies to you, again, speak to your advisor, or it applies to anybody you know, introduce them to your advisor, and we can look at reshaping that life insurance to make sure that they save a whole load more in tax, and as a result, save the equivalent of roughly 30% of the premium. Oh, that beach looks nice, doesn't it? Particularly on a cold day like today. One other thing that you might want to think about is that we've started introducing a few clients to Moneycorp. This is where they've got to exchange sterling into foreign currency, or foreign currency back into sterling. We're talking about sort of reasonably significant sums, so probably £10,000 or more. But if that applies to you, whether it be a personal thing or whether it be for your business, then I'd really encourage you to ask us to introduce you to Moneycorp. We've introduced a few corporate clients and a few personal clients. Everyone we've introduced so far, Moneycorp have been able to source a significantly better rate than they were getting, even though they were shopping around and being smart before. They've managed to get them a significantly better rate. But in addition to that, they've also been able to save some of our clients money through helping them hedge certain currencies, particularly around Brexit. So making sure they did keep the profits that they thought they were getting, and that they weren't lost through market fluctuation. So really, we've worked fairly closely with them now for a year. The results we've had from referring clients, as I say, both corporate and private, into them has been really positive. In fact, at the client review workshop yesterday, one of the clients in the room was singing their praises when I got to this stage, because of how good and helpful they'd been. So if you want to send significant amounts of money to or from foreign exchange, then just let us know and we'll introduce you to the guys at Moneycorp. One thing to be aware of, which I'm sure if you're already a buy-to-let landlord, you probably are aware of, is the changes that are happening to how the tax is dealt with regards to your buy-to-let mortgage. So up until 2016, if you had £1,000 rent and a £600 a month mortgage, then you could offset the £600 against the £1,000 and you only paid tax on the £400. Between 2016 and 2021, that was being phased out, and as a result, by 2021 you'll be paying tax on the full £1,000, even though you're only making £400 profit. This is part of a number of changes that is really stacking the odds against buy-to-let investing. That plus 3% additional stamp duty for second properties, plus a higher rate of capital gains tax for second properties than any other asset. So you pay 10% more capital gains tax for properties than you do other assets, like investments. Plus, of course, all of this in a period of time where we're likely to see rising interest rates, just is, for me, a bit of a huge headwind for the buy-to-let market and the property market. We've already seen a number of clients that have come to us that have either got a few buy-to-let properties or have actually got entire buy-to-let portfolios that they're trying to sell off because this is coming over the horizon. In fact, again, in the workshop yesterday, a couple of clients were saying, I've just had my tax code changed because of this, and I'm suddenly getting hit for more and more tax because of those buy-to-let properties, tax that I wasn't expecting. So I suppose the message is, if you're thinking about selling buy-to-lets at some point in the coming years, you might want to think about doing it sooner rather than later, because I believe by 2021 there'll be a lot of people trying to get rid of buy-to-lets, because if they've gone from making £400 a month profit to £400 a month loss, then they're not going to hang on to that for very long, because it's just not going to be sustainable. So just be aware of those tax changes for the buy-to-let market, because, as I say, I think it's going to cause some people some significant problems. Doesn't affect holiday lets, doesn't affect companies inside limited companies, but for those owned personally, it is a real problem. Now, one of the things that I like to touch on at the client review workshop is the trust framework. And the reason I touch on that at each client review workshop is because actually most of our clients have the trust framework. But in my experience at one-to-one meetings, the number of times I got asked, oh, why exactly did we do that? Or, remind me exactly what we've done there. It's the bit that they can't quite remember what was going on. So it's worth having a bit of a reminder as to what they've done. But also for those clients that may be early in the financial planning process that haven't got round to implementing the trust framework yet, because it often is the secondary piece, it's worth refamiliarizing why it's really important. And to do that, I want to explain what's wrong with just having a will. And to explain that, I'll use Carol and my situation, because it's obviously easier to talk about nasty things happening to me than it is anybody else. So Carol and I have got two girls, Fiona and Bronwyn. And if we just had a will, what you'd assume is that we'd say, well, if something happened to me, I'd leave the house and all of our investments across to Carol, and then she'd want to leave them down to Fiona and Bronwyn, which makes complete sense if it happens. The problem is it often doesn't. So what could stop it happening? Well, ultimately, if on my passing, Carol decided to remarry, let's call him Juan, for example, then if she remarries Juan, then and then gets divorced, potentially Juan walks away with half of Fiona and Bronwyn's inheritance. Even worse, if Carol remarries Juan and then dies, Juan might walk away with all of their inheritance. Even if Juan never happens, then if Carol ends up in a care home, then potentially, well, everything down to the last 23,000 has got to be sold prior to getting any help from the state. And then finally, as and when Carol passes away, everything's in her estate for inheritance tax purposes. Now, you may think that's the end of the problem, but it isn't. Because at the moment, Fiona and Bronwyn are 12 and just about to be 10. So what would happen if we just had a will is that the money would go into a trust, but they'd receive their entire share the day they turned 18. which would probably lead to an amazing Freshers Week, but not a very good life thereafter. We might have a couple of Paris Hiltons running around Rutland. So as and when, you don't want them to inherit too much money too early. As and when they got a bit older and they were responsible with their money, there's still more concerns, because if they were to get married to the son-in-law from hell and a year later he decides he wants a divorce, he's now walking off with half of their inheritance. And of course, when they want to leave the money to their children, they've got to think about inheritance tax all over again. So what does a trust framework do, and how does it protect against those situations? Well, instead of just leaving everything to Carol on my death, what we've done with our trust framework is we've set it up so that on my death, certain assets move directly to the trust immediately. Those will be my life insurance, they'll be my pension, and they'll also be the first $325,000 of our estate. Usually that's a share of the property, not always. I'll come back to why in a minute. Now, what I've put into the trust on my death is made available to Carol in its entirety. In fact, what happens is, as an interest-free loan, it is just handed out to Carol, and she can do with it as she wishes during her lifetime. So if that's a share of the house, she can still sell it, downsize, do whatever she wants, but ultimately it is still a loan from the trust. Now, people get caught up with this loan problem because we've all been taught that loans are bad. But actually, when it's a loan to a loan to a trust that is to benefit the people that you want to inherit later on, from an inheritance tax planning point of view, it's actually a really good thing, because it's reducing the size of an estate that's likely to be pay inheritance tax on, and as a result, your children end up inheriting more. So what's the benefit of doing this? These movements to the trust framework on first death? Well, if Carol does remarry Juan and then get divorced or die, we've managed to ring fence some of those assets to make sure that actually some of the assets will definitely pass down to Fiona Bronwyn. If Carol ends up in a care home, well, the house is partly owned by a trust, so potentially we've protected against care fees stripping out the entire estate. But also, we've ring-fenced some assets from inheritance tax. We've kept them out of Carol's estate so that when she passes away, they're not taxable. This doesn't solve the inheritance tax problem completely by any means, but it reduces it definitely. Then, on Carol's passing, obviously the loan needs to be repaid, and that will be repaid from the estate. And actually, a common question is, what if there is nothing left in the estate? Well, the trust would have no option but to write off the loan, and the trust would be ended, but that's pretty unlikely because there's likely to still be a house or something like that in the estate. But then everything else in Carol's estate is also left to that trust framework. What that means is, when it comes to take it out for the children, firstly, we've got trustees in place that say, well, okay, at the moment, they're not old enough, and actually, even at 18, I don't want them to have access to all of this money. We might give one a deposit on a house, but the other one, the trustees might be a little bit concerned with, and they may say, actually, we're only just going to give you an income for the time being until you kind of prove you're responsible enough. So it protects them against themselves in a way while they're too young to deal with that sort of level of risk. And we've all heard of stories of people inheriting too much money too early and it ruining their life. And clearly we want to avoid that. When they are old enough and responsible enough to deal with this money themselves, it's still best that it's taken out as an interest-free loan in the same way that Carol did up here. Because what that means is, if the son-in-law from hell does decide to marry them and divorce them a year later, then actually we've ring-fenced those assets. Now, if it's 20 years on and they've got married and they've had children and then they get divorced 20 years later, maybe the judge will see through this type of planning. But let's be honest, we're less worried about those types of divorces. It's more worrying about that person that marries them for the money and clears off a year later with a nice chunk of their estate. And then, of course, when they want to leave the money to their children, they can just return that loan, and the grandchildren, my grandchildren, their children, could draw that money out of the trust again, and that would skip a generation for inheritance tax purposes. So whilst this money moving from Carol and I down to Fiona Bronwyn this trust framework is going to save some inheritance tax. It's not going to eliminate it all, but what it will do is it will save a lot of inheritance tax between us and our grandchildren. So it's really powerful planning, and it's got the ability to save you quite a lot of money, not just from a tax point of view, but just making sure that money does flow down the bloodline in the way that you'd want it to. And there were some complications around what's called the residential nil rate ban. So this is where the Tories came in and said they'd increase the inheritance tax allowance up to £1 million, and then they produced quite a complicated piece of legislation that meant that they sort of did, but it's not quite as straightforward as that. It basically, if you have an estate over 3 million, you don't qualify for this extra allowance, and it also has to be linked to a property. So some older types of wills that had trusts linked to them, the sort that were typically done by high street solicitors, can actually cost your beneficiaries this residential nil rate ban, and therefore cost them an additional inheritance tax on an additional £350,000, which clearly you want to avoid. The type of planning I've just talked about is flexible enough so that it can help you to benefit from the residential nil rate ban, and sometimes it actually gives you a way of generating the residential nil rate ban where you might not have otherwise done it. So it's a really, again, a good allowance to try and use if you can, and the trust framework helps you do that. While I'm on the subject of inheritance tax planning, don't forget that you can, people tend to know about the 7-year rule. So you make a gift, and as long as you live for 7 years, it's free of inheritance tax. But gifts out of excess income, so it does need to be income, can't be out of capital, and it needs to be a regular gift. But gifts out of excess income are free of inheritance tax and leave the estate immediately. And it's often missed in inheritance tax planning, so it's just worth remembering that. A couple of other things just to mention as to what's going on at Efficient Portfolio. I hope you've all registered for the investor portal. This year we're going to continue to use it more and more with secure messaging. It's just a far more secure way. I know none of us want an extra password and username, but equally we do want to make sure our money is safe from fraudsters. So using secure messaging has got to be a sensible strategy, and we're going to want you to be using this more and more as the year goes on. So if you haven't registered, please do. Hopefully you've seen the emails telling you about this, but I really encourage you to try and listen to our podcast. Tend to run between 20 and 40 minutes. Variety of topics. We've done inheritance tax, we've done final salary pensions. We did one with the managing director and also one of the investment specialists at Portfolio Metrics, talking about different ways to invest money. We've done one on divorce. We've done a variety of different topics, and we'll continue to do one a month. So I'd really encourage you to listen to them. We're getting some really great feedback from people that have listened to them. So look out for the Fit Finance sessions. You can find them on iTunes, or you can click the link that Charlotte sends out once a month. If you're not getting that email for some reason, just let us know and we'll make sure that you're on the right list. Something worth just mentioning very briefly, historically, you'd have clients with an accountant, a solicitor, and a financial planner, and they were getting advice in all different directions, but then having to kind of weigh up the different pieces of advice themselves. I'd really encourage you to, if you're working with an accountant or solicitor on different projects, introduce us to them, because it's much better if we work together with them for you. It means we can provide a more cohesive approach. We can put our heads together, use all of our expertise, come up with the right strategy for you, and then present that to you, which saves you having to decide which way to turn when there's some conflicting advice in there. So I'd really encourage you to introduce us to your accountants and solicitors where you're actively working with them, because ultimately it allows us to do a better job in what we call the trusted team approach. A few other things to mention. We are really grateful when you refer us to other clients, and as a result, what we want to do each year is give you a big thank you, and that's why we do the referral dinner each year. As a big thank you to those people that have referred us to other clients. We're going to be sending out the invites to this shortly. It will be in Hambledon Hall in Rutland, and Benares, which is a really lovely Michelin star restaurant in London, and obviously Michelin star Hambledon Hall as well. It's a really lovely, relaxed evening. You don't have me standing up and talking about pensions, you'll be pleased to know. So if you do know of other people that you think would benefit from what we do at Efficient Portfolio, please don't keep us a secret. Please tell us, introduce them to us, and ultimately we'll take you out for a really lovely dinner as a thank you. And you'll also get to meet some other clients at the same time, because they tend to keep them around the sort of 15 to 20 mark. So it's a nice group to chat to. It's like a dinner party on steroids, I suppose. And a really easy way to do that, if you've got people that you think might benefit from what we do, but it can be sometimes a bit awkward talking to them about their finances, is just give them or ask us to invite them to one of our events. So historically, we've done the Dream Retirement Dinner, which is a nice dinner followed by some sections from me on how to create a dream retirement. But we also do Leaving a Legacy Lunch, which is more for the post-retirement market for inheritance tax planning. And we do a business owner's breakfast. So if you have business owning friends or family, or people that are post-retirement, or people in the lead up to retirement, and when I say lead up to retirement, the 15 years before retirement, really, I suppose, that you think might benefit from what we do, then just let us know, or introduce us, and we'll invite them to one of our events. In fact, we're doing a version of the Dream Retirement Dinner this evening. Really relaxed way of finding out a little bit more about what we do and how we can help, and then obviously they can take it from there. In addition to coming to one of our events, they also get a number of perks for being referred in by an existing client. They get a free exploration meeting with one of the financial planners. They get a third off their plan fee. And of course, they also get to bump into you at our client events, which, what more could they ask for? So please don't keep us a secret. If you know of other people, we're always really grateful of being referred to other clients. So don't keep us a secret. Now, each year we pick a specific charity to support. Last year it was actually slightly different. Actually, over the last few years we've picked 2 or 3 smaller charities. We found that the message was getting lost a little bit by having more than one charity. So from now on, we're going back to just picking one charity to work with. And this year we've picked the Motor Neurone Disease Association. It's a charity that's very close to my heart. Carol and I lost a friend of ours that had young children to motor neurone disease a few years ago. It's an absolutely devastating disease, but it's been brought back into focus because Charlotte, who you'll all know, has worked with me for over 7 years, her mother has sadly been diagnosed with this dreadful disease. So the MNDA is our chosen charity for the year. We're going to do a few things. We obviously do the golf day every year, which raises a bit of money for it. We're going to do a charity ball again. We did this 2 years ago, celebrating our 10-year anniversary. Because of what's happened, we think that now is the right time to reignite that. So look out for invites. That'll be in November. I also usually get convinced or talk myself into doing something silly to raise some money. So I'll be writing to you fairly soon because I've agreed to run my first marathon. I've never run a marathon before. So I'm signed up to the Brighton Marathon. I actually wanted to do the London Marathon, but MNDA didn't have any more charitable places available. So I'm doing the Brighton Marathon in April. But that didn't seem like a big enough stretch because I've done some other similar sort of things before. So I've stupidly gone and signed up for an Ironman. So Ironman Italy in September. Just for those of you who don't know, it's like doing 3 marathons in a day. It's a 2.6 mile swim, a 112-mile bike ride, and then a 26-mile marathon run just to finish it off. It'll take me somewhere between 13 and 15 hours of non-stop exercise. So it's going to be quite the challenge. I'm not quite sure what I've let myself in for, but it's for a fantastic cause. So I'll keep you updated with that. But if you can support us on that charity, we'd be really grateful because it's really close to our hearts at the moment. Last thing before I return to your pack, if you don't already do so, follow us on like our Efficient Portfolio page on Facebook, because what we call it is not necessarily financial. We share a lot of things that aren't financial stuff, things like TED Talks, interesting articles, and you'll just see a different side to what we do. There is some financial stuff in there as well, but I'd encourage you to like us on Facebook, because I think you might find the content interesting. So back to your review packs, you'll find at the back of that pack is your recommendations and changes. What I would really encourage you to do is just sit and go through those now if you've got another 5 minutes. Complete that. Each area you can tell us whether yes, you like the recommendation, you want us to go ahead and implement it, or you want to discuss it, or you don't like it at all. And then on that form, also, please can you indicate when you'd like your one-to-one meeting organising. Does it need to be prior to the end of the tax year? Is post-tax year better? Is there something big happening in September, so you'd rather it was around then? Let us know on that form when you'd like your one-to-one meeting, and we'll get that booked in as quickly as possible. Because ultimately that one-to-one meeting is still really important. And then finally on that form is your opportunity to give us some feedback. So if you've got any feedback for us, we'd be really grateful that you give it, whether it's good or bad. It's really useful for making sure that we get these things better and better each year. Constant and never-ending improvement is one of our company cultures, so feedback is really important to us. That really is the end of the client review workshop. I'd leave you with one last thought before I come on to questions, which is actually two last thoughts. One is that the secret to long-term growth is withstanding short-term losses. And the second thing is, don't forget that things aren't always as you see or as they seem. So anybody got any questions for me while you've got me here? I hope that's been really valuable. I'm happy to spend a bit of time answering some questions. If you've got any questions, then just type them into the dashboard there, and I'll do my best to answer them. If you don't, and I'll give you a few minutes to type, because I appreciate that can take a little while. If you don't have any questions, I'm really grateful for you guys that have logged in. I hope it's been valuable. For those of you that are watching it recorded after the event, I hope you found lots of value in this as well. Really, please, if you can get those recommendations sheets back to us as soon as possible, we'd be really grateful, because it allows us to spring into action with all of those different recommendations. Obviously, we've now got the tax year end starting to come into focus, so there's a number of those recommendations that will be tax year end sensitive, and the sooner you can get that back to us, the sooner we can implement those and make sure we get it done in time for the tax year. But also, if that relates to if you've got stuff that you need to do with your advisor prior to the tax year, we really want to get that one-to-one back. So I can't see there are any questions coming in at the moment. Let me just get you to raise. If anybody wants to ask a question or is typing, please can you, oh, hang on, I've just got a question popped in now, thank you. Okay, great. So good question from Peter, thank you. If with a trust in place, presumably it's necessary for the trustees to change as time passes. How is that arranged? So that is arranged if you've done the trust planning through us. Firstly, yes, it is a good idea to keep those trustees in mind and potentially review them. You've always got to be thinking, would they be the best people to manage the money in our absence? Ultimately, in the long term, probably, assuming they're UK based, you're probably going to want your children to be your trustees, because they're going to be the ones that are managing. Once they're responsible enough, they're going to be ones that are managing the money for themselves. So excuse me, I just need to take a drink of water. That said, depending on the age of your children and how financially responsible they are, you may have different trustees at the moment. Once your children are your trustees, you probably don't need to worry. In terms of how you change them, if you wanted to, you'd go back to whoever organised that. So if you did it if we introduced you to a firm of solicitors, to do it direct with them, which we sometimes do, or if you've done it with a firm that we work with as you do, Peter, then you can go direct to them. If it's a trust that we created for you, so actually one of your trusts, Peter, we created and one the solicitor did, then you'd come to us to do that in the same way. So for the rest of the clients that are listening to this, if we did your estate planning and you wanted to change your trustees, yes, you'd come to us and we'd organise that for you. Any other, I hope that answers your question, Peter. Any other question? Thank you, Colin. I'm glad that you appreciated it, and and we saved you some travel. Thanks, Peter. That's great. That's brilliant. I assume nobody's got any other questions. Raise your hand if you're going to ask any questions in the next couple of minutes, and I'll hang on. No, I've stunned you all into silence. Fantastic. Well, just leaves me to say, I hope you have a fantastic 2019. Get those recommendation sheets back to us. Get your one-to-one booked in with your advisor, and we look forward to continuing to work with you. And thank you again for your previous support and any future support you give us with any referrals and recommendations. Thank you very much. Have a great day.